When you pay off a loan, the money doesn't go back to the bank. It vanishes. I know that sounds completely wrong, like I'm about to sell you a conspiracy theory, but by the end of this video, you'll actually see it happen on a balance sheet. And once you see it, a lot of things about recessions, credit crunches, and why the economy can slow down, even when people are doing the right thing, financially will suddenly make sense. No jargon, no university-level econ, just one clear mechanism that explains more than you'd think. Let's start with something you probably already suspect. Most money in the economy isn't cash. It's not notes in a wallet or coins in a jar. The Bank of England says about 97% of the money the public holds is just numbers in bank accounts. Deposits. When you check your balance and it says you have £1,000, that's not 1,000 physical notes waiting for you somewhere. It's a number, an IOU from your bank to you. That matters because when we talk about money being created or destroyed, we're not talking about printing presses or shredding machines. We're talking about those numbers going up or going down. Now here's where it gets interesting. You've probably heard that banks lend money, but most people think it works like this. Savers put money into the bank holds on to it, and then the bank lends that same money out to borrowers, like a middleman. That's the story a lot of us half remember from school. The Bank of England says that's not mainly how it works. Neither does the German central bank, the Bundesbank. They both say the same thing. When a commercial bank makes a loan, it usually just creates a new deposit. The act of lending is the act of creating money. Let me show you what that actually looks like. Imagine a bank approves Alice for a £10,000 loan. What happens on the bank's books? The bank creates a £10,000 loan as an asset. That's money Alice owes the bank. And at the exact same moment, the bank credits Alice's account with a £10,000 deposit. That's money the bank owes Alice. Both entries appear at once. The bank didn't need to wait for someone else to deposit £10,000 first. It didn't pull the money from a vault. It just updated two sides of a ledger. Alice now has £10,000 she can spend, and that deposit is new money in the economy. Pause for a second and think about what that means. If lending creates deposits, and most money is deposits, then most money comes from lending, not from a government printing press, not from a central bank directly handing it out, from commercial banks making loans. The Bank of England puts it clearly. The majority of money in the modern economy is created by commercial banks making loans. All right, so if banks create money when they lend, here's the question that should be nagging at you. What happens when you pay the loan back? Most people assume the money just goes back to the bank, like returning something you borrowed. The bank gets the money, and now it has more money to lend out again. That feels intuitive, but that's not what happens. Let's go back to Alice. She's got that £10,000 loan. Now let's say she repays £1,000 of the principal, the actual borrowed amount, not the interest yet, we'll come to that. She makes the payment. £1,000 leaves her account. Her deposit balance drops by £1,000. And on the bank side, the loan shrinks by £1,000. Here's the key part. The bank's balance sheet just got smaller. The loan asset fell by £1,000. The deposit liability fell by £1,000. That money didn't move to a pile somewhere. It didn't get transferred into the bank's vault. It was erased. The two matching entries, the IOU Alice owed the bank and the IOU the bank owed Alice, canceled each other out. That £1,000 of deposit money is gone. The Bundesbank says it directly. When borrowers pay back loan installments, the book money that was created is destroyed. Let me say that again, because it's the center of the whole video. Paying off the principal on a bank loan doesn't send money back into circulation. It removes money from circulation. The deposit that was created when the loan was made gets extinguished when the principal is repaid. Now, if you're thinking, wait, but what about the interest? Good. That's exactly the right question. Interest is different. Interest isn't the reversal of the original money creation. It's the price of the loan. It's income to the bank. When Alice pays interest, that money doesn't vanish. It becomes revenue for the bank. The bank can use that income to pay staff, pay dividends to shareholders, pay suppliers, cover costs. And when the bank spends that money, it flows back into the economy as someone else's deposit. So here's the clean distinction. Principal repayment destroys the deposit that was created by the loan. Interest is income. It doesn't reverse the money creation. It's just a separate payment stream. That might sound like splitting hairs, but it's actually crucial because it means the money supply can shrink even when banks are profitable. All right, let's zoom out. Why does this actually matter? Why should you care that paying off loans destroys money? Because if one person pays off a loan, that's fine. Probably healthy for them, actually. Less debt, less interest burden, more financial flexibility. But if lots of people start paying off debt at the same time and not taking out new loans to replace it, then you get something economists call deleveraging. And deleveraging can be brutal for the economy. Here's why. When people are aggressively paying down debt, they're often cutting their spending to free up cash for those repayments. The Bank for International Settlements, that's the central bank for central banks, says that when highly indebted households try to deleverage all at once, they cut spending, and that spending drop spills over into lower output and weaker growth across the whole economy. Sometimes it triggers a recession. And at the same time, the money being destroyed through loan repayments isn't being replaced by new money from new lending, because during downturns, banks tighten their standards. They lend less. Borrowers are more cautious. Credit growth weakens. The European Central Bank has tracked this in past recessions. Credit growth tends to fall before and during recessions, and it recovers only gradually afterward. So you get this double hit: people spending less to service debt and less new money being created because lending has slowed. The result is fewer deposits circulating, weaker demand, slower growth. The Bank of England puts it clearly: when households and firms face higher debt servicing costs, they cut spending, and that worsens the economic environment. Here's the uncomfortable bit. What's good for you as an individual, paying off your credit card, clearing your mortgage early, can be contractionary for the system if everyone's doing it at once and new credit isn't filling the gap. You're doing the responsible thing. You're reducing your risk. But in aggregate, that behavior can slow the economy. It's not that paying off debt is bad, it's that the system runs on a flow of money, and a big chunk of that money is created through lending. When lending slows and repayments rise, the flow weakens. This is one reason why booms and busts feel so different. Booms are often credit-heavy. People are borrowing. Banks are lending. Deposit money is being created faster than it's being destroyed. There's more spending power sloshing around the economy. Busts are often deleveraging heavy. Lending dries up. Repayments grind on. Deposit money shrinks. Spending drops. Growth stalls. And the really important thing to understand is that this isn't some side effect. It's not a bug in the system. It's how the system works. Modern money is mostly bank deposits. Bank deposits are created by lending and destroyed by repayment. That means the money supply is always in flux, and credit cycles drive a lot of the economic cycles we experience. So, what should you take away from this? First, money isn't a fixed pile of stuff. It's a constantly shifting ledger of I owe us. Banks create deposits when they lend. Those deposits are destroyed when principal is repaid. That's the mechanism. Second, your personal financial decisions are still your own. Paying off debt can absolutely be the right move for you. Lower risk, less stress, more control. But understanding the macro picture helps you see why recessions feel the way they do and why central banks pay such close attention to credit growth. And third, and this is maybe the most useful bit, once you see money as entries on a balance sheet rather than physical objects being moved around, a lot of economic weirdness starts to make sense. Why do central banks care so much about lending? Because lending creates money. Why do credit crunches feel deflationary? Because they shrink the money supply. Why does deleveraging hurt growth? Because it destroys purchasing power. You don't need a degree to understand this, you just need to see the mechanism once, and now you have. If this clicked for you, there's more where this came from. But for now, you've got the core idea. Loans create money, repayments destroy it, and that's not a conspiracy, it's just accounting.